What if the world isn't powered by money, but by credit? Not wealth, but permission to access wealth. And what if the real engine driving the global economy isn't innovation, labor, or productivity, but a silent machine that expands, contracts, and manipulates the flow of credit in ways almost no one understands? Because here's the strange truth. Most of the money you think exists doesn't. It's created the moment someone borrows and destroyed the moment someone repays. This machine, the hidden credit machine, decides which nations rise, which nations fall, why some countries stay trapped in endless borrowing, why inflation keeps climbing, and why the cost of living only moves in one direction. Yet almost every citizen believes their government, their paycheck, and their bank account reflect something real. Tonight, we unveil the system designed to make entire nations dependent on credit, the system that built the modern world, and may also destroy it. To understand how credit became the backbone of global power, we need to go back, not decades, but thousands of years. In the earliest civilizations, credit wasn't a financial instrument, it was a social contract. Farmers borrowed grain, merchants borrowed silver, families borrowed livestock. Debt was personal, local, moral. But something happened when trade expanded between temples, kingdoms, and empires. Credit became scalable. The key figures weren't kings, they were scribes, merchants, and priests who developed early ledgers. By tracking obligations on clay tablets, they accidentally created something revolutionary, a system where wealth could be promised into existence before it existed. Fast forward to the Roman Empire. The introduction of promissory notes allowed citizens to transact without carrying gold coins. Credit became mobile, credit became transferable, credit became powerful, but even then, credit wasn't yet the machine it would one day become. To find the origins of that, we jump to Europe. In the late Middle Ages, Italian city-states like Venice, Florence, and Genoa were blossoming into financial powerhouses. They discovered something worth. It's more profitable to lend money than to trade goods. Bankers learned they didn't need to physically possess the gold they lent out, they just needed people to believe they had it. With that illusion, they could issue bills of exchange, merchant credit deposit slips, and early banknotes, often in amounts exceeding their reserves. And here we see the first real gears of the credit machine. 1. A borrower receives credit. 2. That credit is used for trade or investment. 3. The banker charges interest. 4. The banker relents the deposits. 5. More credit enters circulation. The result: economic expansion powered not by savings, but by promises. This single innovation changed war, government, and commerce forever. But something even bigger was coming. By the 1600s, European powers realized something dangerous. Private bankers had more control over economic growth than kings. So nations moved to integrate the credit machine into the government itself. The Dutch invented government bonds, a way to borrow from the public at scale to fund trade and war. The British refined it into a national system. The creation of the Bank of England in 1694 marked a turning point, a central bank that could issue notes backed by government debt. Suddenly, government promises were the currency. This created a self-reinforcing loop. Governments issue bonds, banks buy those bonds. Banks use them as collateral. This wasn't a flaw. This wasn't an accident. This was by design. Credit had become the engine of national power. The nations that mastered this machine, Britain, France, later the United States, didn't just grow economically, they dominated the world. For centuries, credit still had a limit. It was tied to precious metals like gold or silver. But to world wars, a Great Depression, and a global rebuilding challenge shattered that restraint. Countries needed more credit than gold allowed. The breaking point came in 1971, when the US ended the convertibility of dollars to gold. From that moment, credit no longer needed backing. The world shifted from commodity money to promise money. Central banks could issue unlimited liquidity. Commercial banks could create deposits out of thin air. Governments could borrow endlessly. Economies could grow on leverage, not productivity. Credit stopped being a tool. It became the system itself. This brought prosperity for a while. But it also created the biggest vulnerability in economic history. When everything runs on credit, everything collapses when credit freezes. We saw it in the 1980s Latin American debt crisis, in Japan's 1990s credit bubble burst, in the 2008 global financial crisis, during the 2020 pandemic liquidity shock. But these weren't random events. They were the same mechanism cracking under pressure. The hidden credit machine reshaped the world in ways governments never publicly admit. Nations become permanent borrowers. Once a country taps the machine, it can never leave. Why? Because modern economies require constant lending, borrowing, refinancing, liquidity injections. Without credit expansion, GDP contracts. And without legitimacy, politics explodes. 2. Banks become the gatekeepers of growth. Most money today is created not by governments, but by commercial banks the moment they issue loans. This means banks decide who gets to participate in the economy. Banks decide how much money exists. Banks decide which industries boom or collapse. Banks are the heart of the credit machine, not governments. 3. Citizens become dependent on debt. When prices rise faster than wages, which is built into the system, people must borrow too. Buy homes, pay for school, start businesses, manage emergencies, afford basic life milestones. You don't choose debt, debt chooses you. 4. Global institutions become credit enforcers. Organizations like the IMF, the World Bank, the BIS, global bond markets, essentially police the world's credit hierarchy. Rich countries lend, poor countries borrow. Borrowers become dependent. Dependence reinforces power. The credit machine traps entire nations in a cycle of borrow gives. Every decade, world leaders claim they're going to fix the debt and credit crisis. They propose balanced budgets, stricter banking rules, lower leverage ratios, austerity programs, new regulations, spending limits. None of it works. Why? Because the machine is not malfunctioning. It is functioning exactly as designed. The global economy only grows when credit grows, so policymakers are trapped. If they reduce credit, economies shrink. If economies shrink, unemployment rises. If unemployment rises, governments fall. If governments fall, new governments restart the credit machine. This is why every crisis ends with more bailouts, every recession ends with lower interest rates, every bubble ends with more liquidity, every problem is solved by creating new credit. The machine protects itself at all costs. Look at the world today. Every region shows the same repeating pattern. The United States record government debt, record corporate leverage, record household borrowing, record credit card balances, record student loans. The machine is running hotter than ever. China massive credit expansion built its economic miracle, but also its property bubble. Europe, dependent on central bank liquidity to keep entire nations solvent. Developing countries trapped in cycles of IMF loans, bond refinancing, and currency devaluation. Consumers worldwide increasingly reliant on BNPL services, mortgages, car loans, personal credit, revolving debt. The average person's financial life is now defined by access to credit, not savings. Shocking patterns across the world. Debt rises faster than GDP. Credit access determines national prosperity. Crises occur whenever credit tightens. Inequality widens as asset owners benefit from leverage. Inflation becomes structural, not temporary. Currencies slowly weaken over time. These aren't coincidences. These are signatures of the same global credit machine at work. Different countries, different cultures, same mechanism, same dependence. After everything we've explored, what exactly is this hidden credit machine? Here's the clearest description: a global system where money is created through debt. Debt requires constant expansion. Expansion creates dependence. Dependence reinforces power. And the system must inflate forever to survive. The machine has 4 core pillars. 1. Credit creation. Loans create money. 2. Leverage expansion. Economies grow by increasing borrowing. 3. Institutional enforcement. Central banks and global lenders ensure credit never stops flowing. 4. Dependence cycles. Citizens, corporations, and governments become trapped in permanent borrowing. This machine dictates interest rates, inflation, asset bubbles, currency, strength, political outcomes, trade imbalances, national sovereignty, your standard of living. It is the most powerful force in the modern world, and yet most people have never heard of it. Take away one: money is credit, not cash. Most money is not printed, it is borrowed into existence. The world runs on credit creation. Take away to debt expansion is structural, not optional. The global economy collapses if credit stops expanding. This creates perpetual dependence. Take away 3, the system favors asset owners, not workers. Credit benefits those who borrow to invest, not those who work for wages. Inequality is a built-in outcome. Systems built on ever-expanding leverage don't fail slowly, they accelerate, then break suddenly. No empire in history has survived when its credit machine outgrew its real economy. We are living in a moment where global credit has reached unprecedented levels, and the machine is straining. When the next freeze comes, it won't be just a recession, it will be a reset. The only question is, will we understand the machine before it stops, or only after? If this deep dive helped you see the world differently, and if you want more videos uncovering the hidden architecture of modern money, debt, and global economics, subscribe, like this video, and share it with someone who still believes the world runs on cash, not credit. Because understanding the machine is the first step to escaping it.